When will the pain stop? Will last month's lows be able to hold, or are we looking at still one more leg down? You know, this is what I think about every day. So far this year, bottom fishing, we know, it's been a fool's errand. But stocks have now come down huge from their highs, and Wall Street feels a lot less blindly optimistic than 6 months ago. Positive. That said, it's an insanely emotional market, and when you're trying to spot a bottom, or a top for that matter, you need to take these emotions out of the equation. What we want is a more empirical approach to the market to go with that top approach that I gave, which made me, which was pretty bullish. So that's why tonight we're going off the charts with the help of Tom DeMark and his team at DeMark Analytics, whose work you can follow at symbolic.com, SYMBOLIK.com. Now, DeMark's a legendary figure in this business. He and his team have an incredible track record when it comes to time in the market, one that goes back decades. And what you need to know now is that he's feeling good about vast swaths of the stock market. Rather than searching for patterns like a typical technician, DeMark's all about trying to identify when markets are likely to change course, ideally ahead of time. That's why he's always on the hunt for signs of trend exhaustion and price reversal inflection points. Those are the language that he likes, and I've learned to use it. You need to, too. Now, I don't want to go into too much detail about how the system works, in part because it's complicated, but also because a lot of this stuff is proprietary. Now, you can go to symbolic.com to learn more. But what matters here is that DeMark's proprietary indicators come down to the basic tenets of supply and demand. Remember, at the end of the day, the stock market is a market, and all markets are controlled by supply and demand. When demand is greater than supply, stocks go up. When supply is greater than demand, stocks go down. DeMark's dedicated his whole career to spotting moments when these dynamics change. Makes sense to me. Very intuitive and rational. So when we're hunting for a bottom, the key is to identify when the sellers have run out of firepower, when everybody who is going to sell has already sold. I often talk about that, seller exhaustion. This usually happens before things get better. In fact, markets tend to bottom on bad news, not good news. You know, the lows are in when something awful happens and stocks go up anyway. Think about what happened with Micron. Bad forecast, stock went up anyway. So what does this have to do with the actual market? Let's start with the Dow Jones Industrial Average and the S&P 500. On May 19th, the day of the market's previous big low, DeMark's timing model predicted we get two successively lower lows and closes before the averages bottom. The Dow and S&P hit those targets 2 weeks ago. However, because there was a 2-week rally off the May 20th low in the first week of June, DeMark's timing model required an extra day of weakness to recalibrate. He and his team have a 13-step buy or sell countdown model that helps them identify potential highs and lows. You get a certain number of sessions going in the same direction, and sooner or later, the trend exhausts itself. There's more to it than that. But what you need to know is that the S&P 500 hit 13 on the buy countdown on June 16th, which suggests this was a real bottom. As for the Dow, it hit 13 on the buy countdown the next day. But there's a secondary countdown that's still only at 12. To DeMark, that means the Dow may have bottomed last month, or maybe there will be one last downdraft that takes us to a lower low. Now, DeMark's been doing this kind of analysis for 50 years. And he sees some parallels between the current market and the early 70s. I want you to take a look at this chart, which shows the daily action in the Dow this year versus the daily action in 1973. As you can see, boy, that was a period of malaise. As you can see, he was using the same 13-step countdown even back then, and it worked just as well as it does now. They believe the relationship is noteworthy, and if it holds, we see some more choppy trading for the Dow over the next couple of months, followed by a strong rally in September and October. Okay, remember, we're following a pattern of 73, all right? But then a large decline into the end of the year. If DeMark is right, then right now we could be looking at an incredible trade. Next, how about the NASDAQ composite? As you can see, DeMark's methodology called the top in this thing last November. The tech-heavy NASDAQ had run so far so fast that the uptrend was exhausted, and then it was overwhelmed by selling. You know, remember what happened that was when the Fed got tough. After that, we got 4 straight months of weakness, but then in March, the NASDAQ hit DeMark's 13 buy countdown, and we got a nice rally off the lows. By the end of March, though, we got another sell signal. This thing's really tough. A completed 9 sells setup, and the NASDAQ experienced another leg lower. Right now, it's at 12 on DeMark's 13-step bottoming countdown, meaning the bottom probably isn't here yet. It also hasn't hit his lowest downside price target yet. More on that in a second. How about the NASDAQ 100, the extremely tech-heavy index made up of the 100 largest non-financial stocks in the NASDAQ composite? Take a look at the QQQ, which actually recorded a 13-buy countdown in the middle of last month. But here's the thing. it's not enough to just hit 13 on DeMark's trend exhaustion countdown. In a market this tricky, he won't try to call a bottom until an index also hits his downside targets. Neither the NASDAQ Composite nor the NASDAQ 100 did that. He doesn't expect them to bottom until the former hits 10,515 and the latter hits 268. So that's the number you have to think about. DeMark also has a tool that he calls his market map model, which surveys historical price action in order to predict the market's future movements. He's applied it to the NASDAQ 100 and has come up with a forecast that looks a lot like the 1973 run for the Dow. Specifically, DeMark sees an upcoming near-term low, followed by a rally into the end of July, but then a decline into the end of August to a newer low. After that, however, he's expecting that sharp rally we talked about into late October that could recover 55 to 60% of the entire 2022 decline. So obviously, you want to be in for this. If you had another analogy, DeMark thinks this upcoming bottom could be a lot like the late March of 2020 bottom, when everybody thought the world was ending, but the averages quickly bottomed, in part because the Fed was printing money like crazy, and in part because everybody who was going to sell had already sold. Remember, markets bottom on negativity, not positivity. We've spent months getting hammered based on the same horrible story. The sooner or later that gets baked in, and then you're okay. And look, it's not like there's no good news. We spent all year terrified of how the Fed might have to destroy the economy to kill off inflation. But one look at the commodity markets tells you that the Fed's made tremendous progress in containing inflation, at least in commodities, after two aggressive rate hikes. So I think DeMark might be onto something. Here's the bottom line. The charts as interpreted by Tom DeMark suggest that with just a little more weakness, this market's finally got a legitimate chance to bottom for the first time since everything started rolling over last November. The S&P 500 might have already put in its lows. I hope he's right, and more importantly, I think he is right. Let's go to Michael in Colorado, please. Michael.
Hey, Jim. Booyah from Colorado.
Booyah, Michael. What's going on?
All right. You think Coinbase has what it takes to ride out the bear market, or are we going to see more deterioration along with some of the other cryptos?
Well, I don't really care for Coinbase. Coinbase. I wish it were Coinbase, like the Coin Exchange that was the third in Arch in Philly. Here's my problem with Coinbase. We have, even with the best of banks, the best of banks are all hard stocks. Now, I think they're going to get better. But I need the upside from a bank here, and I don't think Coinbase can, which rescinded offers, and people are saying is having a hard time getting talent, can necessarily be the one that you want to be in for the financials. Let's go to Tyler in California, please. Tyler.
Booyah, Jim. How you doing?
I am doing well. How are you?
I'm all right. Thank you for asking. So I was wondering, the stock I'm watching that moves up 1.4% in the same direction for every 1% move in Bitcoin, assuming I was bullish on Bitcoin, of course. I was wondering if Mara, since it's down 80% from its highs, if this would be a long-term hold in correlation with Bitcoin.
Well, I think it is definitely a correlation with Bitcoin. I'm just not sure I want to be correlated with that. I was checking in some people. My mentions column at Twitter, always nice and not remunerative. And people were saying, well, Jim, so now you tell us you don't like Bitcoin. I once again remind people that I sold my Bitcoin dramatically higher and bought a farm in Pennsylvania. And I would never think about selling that farm and buying Bitcoin. And that's not just because there's tremendous largemouth bass in the pond. All right, the chart suggests this market finally has a legitimate chance to bottom for the first time since November. I think Tom DeMark's right. Now, much more Mad Money ahead. Buy now, pay later seemingly turned into buy now, pay never. So I'm taking a closer look at the players in the space to see what the future could hold. Then, ahead of Friday's employment report, what key aspects should we be watching that we're not? I'll give you my take. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.